Well, good morning, everyone. Welcome to part one of our three-part webinar series on transition planning. This webinar series is being co-hosted by James Moore and Company and Velocity Advisory Group. We're really excited to have you here today and looking forward to hear from really a great panel of experts. They all have substantial experience in transitioning and helping clients transition their business, sell their business. Really, when I use the term expert, I really mean it in this case. So we're really excited to have them, and I'll be introducing them in momentarily. When we started having a conversation with Velocity about transition planning, and this has been in the works for quite a number of years now, but one of the things that we find is business owners struggle to go through the transition process, or all of a sudden they're selling their business, and unfortunately oftentimes they fail to maximize the value, or they have a very difficult transition, and oftentimes they're not even able to sell their business at the time they want to. And really a lot of it gets back to a lack of understanding of how to go through the transition a proper way, how to utilize advisors in a way that will help them through the planning process. So this webinar series is really designed to get you started down that road and help you understand the do's and the don'ts of the transition planning process as you prepare for ultimately that transition. Whether that's in a year, 3 years, 5 years, there are steps that you can take and be prepared for right away. And each of the topics that we're going to discuss today and in the future alone could be a day by themselves, but we're trying to cut down to the most important pieces that you can pull out, so that way you can begin this process. Our other two webinar dates are July 14th and August 11th. And you should have that as part of your registration process. If not, you can always email us and we can make sure that you get that email to register and make sure you're part of that. Today's session, though, is going to be broken down into two parts. The first is what is transition planning and why you need it. We're going to take the next probably 50 minutes. We're going to take a break around 10:55 to transition over, and common missteps in a business transition. That will be at our 11 o'clock hour. My name is Mike Sibley. I'm a partner with James Moore and Company, and I'll be the host of this first panel discussion. James Moore is an accounting advisory firm that provides audit, tax, outsource accounting, CFO, transition planning, outsource IT, and outsource HR services. At James Moore, I lead our transition planning services and our manufacturing industry group. During the session, you may have questions. We have a full set of questions we're going to be going through, but please submit your questions. There's a chat box, and you can select the two who it goes to, and it'll be all panelists. If we're not able to get to your question during this session, we will take notes on the questions and I'll follow up with you. If you could please direct that, or if it's just a general question, then we'll make sure that it gets followed up with you at a later time. Let me now introduce our panel. First, Heather Parks with Velocity Advisory Group. She is a director of transition services, where she helps leaders and organizations navigate change and oversees value acceleration services aimed at helping organizations prepare for ownership transition. Heather has always been driven to empower others to achieve more for themselves and their organization. She is a certified exit planning advisor and certified business coach who has also sold and exited a business herself. Her experience as a CEO and business owner, combined with her background in psychology, facilitation, and training, give her a unique perspective into organizational dynamics. Scott Bushke is the managing partner and founder of Cornerstone Business Services. With more than 20 years in the M&A industry, Scott is a recognized leader in the field, providing exit strategies, sell and buy side transitions, along with valuation services in the lower middle market. Over the years, Scott has successfully executed hundreds of transactions domestically and internationally, working with private equity firms, family offices, and strategic buyers, both public and private. Scott has trust and respect of CPA and financial advisor alliances, investment banks, and other professional service firms around the M&A marketplace, and is apparently on his way to becoming a bit of a movie star in the M&A world. Jeffrey Hogue is with UBS Financial Services. Jeff has been helping a diverse clientele of business owners, professionals, executives, and affluent women investors facing life transitions, as well as multi-generational families with all aspects of their financial lives. His background as a commercial lending officer and private banker, combined with his MBA experience as a portfolio manager, and his designations as both a certified financial planner professional and certified exit planning advisor are given a rare set of skills and insights that set him apart from our other advisors. As you can see, this is a very talented group of people that we have here with a tremendous amount of experience. So I'm looking forward to hearing some of their responses to the questions that we've laid out. But first, let's jump in, Heather, and let's just start with, generally speaking, what is transition planning?
So generally speaking, transition planning is having a business strategy that's aimed at helping the leader prepare their organization and themselves so that they can leave their organization on their own terms when and how they want. And I think I want to stress the importance of the strategy piece in that, because really for two reasons. First is transition planning, developing that strategy really is just good business strategy in general, because it focuses in on the very same things that are going to drive value and drive performance and improve your retention, improve your client experience, all of the things that make a good business good, right? So you've got that piece of this. And then also the other piece that I think is critical about the strategy of it is that while we all would love to be able to exit our businesses at the exact time that we want and get everything that we want out of it, in reality, it's estimated that about 50% of the time, business owners are having to leave their businesses before they're ready. So due to death, divorce, disability, distress, or disease. So really being able to have a plan in place to help navigate those unexpected transitions, I think is key. On top of that, you add in that a lot of times when a business is listed for sale, it's not going to sell, and that's due to that lack of preparation. So really, again, it's about maximizing the value and performance of your organization so that you, the leader, can step out when and how you want.
So just to follow up on that, how does somebody even begin this process? What are the first couple of steps? Because I think sometimes when you're trying to do something, the first step is usually the hardest. And so how does somebody even begin on this? What are the first couple of steps that you see as really important?
Yeah, I think you can look at it as you would developing any kind of strategy. And it's similar to how a GPS works in a car. You need to know where you're starting from and you need to know where you're trying to get to, right? So having a basic understanding of what your business is worth. So getting a good estimate of value at the beginning. So you want to know what the value of the organization is and how it's performing across some key factors. And then from there, knowing what you're trying to get to. What do you need when you're ready to retire or step out? What's that next phase of life look like for you? So not just from the financial perspective, but like, what do you want your life to look like after the fact? Are you going to go start another business? Are you retiring? Are you going to go, live in the Keys? Like, what does that look like for you? So knowing where you're going to start and where you're going to go. And to even get that level of information, it's important to really pull together the right team of advisors. So you want to make sure that you've got the right professionals at the table, a good accountant, wealth advisor, M&A professional, all of the people that are on this call, on this panel today are the types that you need. And making sure that those are people that you really trust to look under the hood and that you feel comfortable and open being transparent with them. And then I think the last piece that's really critical is because you're going to be able to lean on these people to help guide you through this process. And it is a complex process. The last critical piece is making sure that they're able to collaborate with each other. Because if your accountant can't talk to your M&A, person, like it's just it makes things very messy and can be very frustrating and detrimental to the process overall. So making sure that you've really built a strong team of advisors that collaborate and communicate really well, I think is the next critical starting piece.
Right, so you brought up actually so this discovery process at the beginning is really figuring out where are you at now, and so you mentioned understanding the value of your business. So Scott, help us understand, understanding the value of the business. Why does it matter now versus, if you're not going to sell your business for 2, 3, 4, 5 years, what does it matter? What is that like from your side of things in helping a business understand here's where we are right now?
Yeah, that's a great question. And unfortunately, only about 15% of businesses out there get some kind of evaluation done in 2 to 3 years, every 2 to 3 years or at all. So, what it does is it helps you understand what is that value. Most business owners typically don't know the value of the business. It's not like a house where you can look up all the comps that are public comps and things like that because of confidentiality and all these privately held companies. No one tells anybody what was the value or the structure or things along that line. So it's really tough to know on your own. And what it gets you is that reality check of where am I truly at today. And what it also does is, as Heather mentioned, is it allows you to point to, like when we do our estimates of value, it says, okay, hey, here are the 2 or 3 things you're doing really well. Don't stop doing those. Don't take your eye off of those. But guess what? I've been doing this for almost 25 years. I have not found the perfect company yet that checked every box. So here's the 2 or 3 areas that you should really focus on, and then working with someone like Heather's team to build up that value. Or, a lot of times the financials aren't cleaned up. So, to help help clean up the financials and maybe do audited financial statements or do a QV or things like that. But what it does is it gets to that opportunity because, as Heather mentioned, half the time we all as entrepreneurs think we're going to live forever and nothing bad's ever going to happen until it does. No one predicted COVID, and also now we have to deal with that. So it's allowing you to prepare now for whatever that opportunity might come. And I think it helps, as Heather mentioned, build that roadmap to success and understanding the importance of timing. That right now, ironically, is a great time to sell your company, where you might think otherwise. And too many people just wait for an age and say, okay, when I turn 65, I'm going to sell. Well, what if that was, March of last year, or September 12th of 2001? There's just times when you're going to get more for your business, and there's times you're going to get less for your business, and that's all things that are out of all of our control, out there in the marketplace. So by being proactive versus reactive, not only is it now less stressful, because now instead of where most business owners just wake up one day and it's not fun anymore, and now they've got to now they're stressed, they're burnt out, they're stressed out, and they got to make all these huge decisions on probably what's going to be their largest financial transaction of their life. Going through this process, planning 2, 3, 4, 5 years in advance, allows you to understand what your options are, what your value opportunities are to really grow the business or build the value or make it more saleable. And ultimately, it just gives you more options. Do you want to pass it on to your kids? Do you want to pass it on to your management team? Do you want to sell it to a third party? Depending on how you build up the company, some of those options or all those options might not be on the table.
Mm-hmm.
There's studies out there that show that only 20 or to 30% of companies successfully sell. So, it's not like, hey, I'll just, whatever I feel like it, I'll sell and I'll get everything I want. By starting early, it allows you to get as many of those options on the table. And that's what people like are, those options.
Scott, I mean, that's great advice and absolutely agree. Understanding where you're at will help you understand where you need to be. And I guess, you threw around this term, though, of an estimate of value. Heather mentioned the same thing. Can you just briefly describe what exactly is an estimate of value?
Yeah, so an estimate value that we do is it's not a certified valuation. It's not something that if, you're going to court for a divorce or something like that, that would be more, Mike, what your firm would do. But an estimate of value is just $2,500. It's a cost-effective way to realistically know what the business is worth in today's marketplace. So we tend to shy away, not right or wrong, but we tend to shy away from more of the formula-driven models and look more at what's truly going on in the marketplace. Taking a look at your company the last 3 to 5 years, recasting the financials, adding back, one-time costs, personal expenses, normalizing your salary to a fair market salary. Same thing with rent if you own the real estate in a separate LLC. And then taking a look at other companies of similar size and scope in your industry. What have they actually sold for? Because we've got access to different databases that have family-owned businesses, privately owned businesses that are in similar size and scope to your business, that we can take a look at and say, what's really going on out there in the industry, along with the Cornerstone International Alliance that we're a part of, talking to different industry experts or other people that have actually got deals done themselves to see just what are buyers looking at, what do they value. So at the end of the day, it's really trying to give you the most accurate, realistic picture of what your company would be worth in today's marketplace. Now, that's not the same of what it'd be 2 to 3 years from now, even though if your cash or your revenues were the same, it's, again, the things like are banks lending money? What are the interest rates at? Or, what's the attitude on buyers? What are the uncertainties in the marketplace? That'll all help increase or decrease the amount of money you're going to get. But for most businesses, it's really tied to cash. We say cash is king.
Right.
So for most businesses, it's based off of EBITDA, or that adjusted earnings that we talk about. And only in companies that have true reoccurring revenue do you look at multiples of revenue. Otherwise, it's all about how can we drop that, how much cash can we drop to the bottom line. And the last piece that I'll just take here is that, again, the mistake that a lot of people make is that, they wait till it's not fun anymore and they're running away from something versus going towards the next chapter in their life. So they kind of get into this lifestyle business and burn out a bit. And they go, well, yeah, but, I want to get this out for my company because look what it did 5 years ago when I was in my peak. But buyers, unfortunately, don't care about what you did 5 years ago, 10 years ago, or whatever it was. What they're really looking at mostly, if not 100%, is what is that TTM, or trailing 12 months. So it's not even what you did in the last calendar year anymore. It's what were the last 12 months of your business. What did that do? Because that's the best picture of what the future is going to be. So because what they're buying is that future cash flow of that business. So I've seen so many sellers go, oh man, if I've been in business for 30 years, I held on just 3% too long, which was 12 months. How could that affect 20 or 30 or 40% of my value? And, unfortunately, it's not fair. Well, it might not be fair, but that's reality. So that's why, I commend you and Heather and Velocity for putting this together. Because if we could just help people start having this conversation and understanding their options, understanding what the value drivers are, and having them start to work with the right teams, it'll really drive that valuation.
All right. Yeah, no, those are all great points, and thank you for clarifying what that means. Now, so Jeff, this is really driving. So what we're doing is we've learned, this discovery process about the business is very important. One of those components is understanding, hey, there's a large financial transaction coming here, and for many business owners, this is going to lead to potentially retirement down the road. But is that going to be enough? If most business owners, a substantial portion of their wealth is tied up into the business. So what do they need to do early on as part of this process? Understand, what does this mean for me? What does this transaction potentially mean for me down the road? And so what do they need to do with that?
Well, that's great. And just to echo what Heather and Scott said is that, early on is the best practice. Bottom line is no two businesses are alike, even if they're in the same industry. And ultimately, it comes down to managing the risk. At the end of the day, this is the largest asset most families own. And although it is the generator of cash flow, it's also the risk that it represents to the legacy and to the lifestyle that will be achieved after the exit. And as Heather said, every business owner does exit. It's just how do they exit? And having a plan can help you have a little bit more control over that. While you can't control necessarily the price per se, there are things you can do to de-risk the company from making it more attractive to potential buyers, or lining up the right employees and make sure you have the key staff in place to continue on, to having the right estate plan in place to protect the legacy if something happens, unfortunately, to the business owner, which happened in my own family. Had proper planning had happened on the front end, we would have saved or preserved a lot of money. At the end of the day, it's critically important, though, to understand what the lifestyle currently of the business owner and their family is, and what those needs and goals might be ongoing, as well as what the legacy goals are. At the end of the day they may have competing goals, but most business owners, particularly if they've use the business as a method to not only fund their lifestyle, but to get some of the perks of pushing things through the business, such as, cars and cell phones, et cetera. They're now going to be absorbing those costs without the income coming in necessarily from the revenues of business. And so adjusting, as Scott mentioned, normalizing those expenses and realizing that a lot of those are going to go to the family ongoing. How do you plan for that, of course, with inflation? And how do you look for all the things that could derail the whole process, the risks that come down the pipe, the simple things like inflation, healthcare concerns down the road, The lifestyle changes. Many people have gotten used to spending time traveling and doing things with the perks from their business, either the cash rewards cards or travel rewards, but that no longer will be flowing into them. So understanding that and understanding what those legacy goals are important, and understanding how they're prioritized. I tell clients all the time, we're not trying to manage for returns, we're trying to manage risk. Returns are going to be given to us by the markets. We just have to understand what risks we're willing to take and how do we solve for those risks with the least amount of cost or effort as possible. The bottom line is, again, it's not really what you make on the sale on the front end, it's what you keep after tax too. So structure is really important. Obviously the sales price is a key factor, but depending on, how the sale is structured, is it an asset sale? Is it a stock sale? Do you hold things back? Do you have an earn out? Do you have, how much time are you going to spend in the business? Again, seller financing, the risks you're taking there. You got to look at the tax implications. What are the cash flow implications going forward? The estate planning, even before the transfer or after. And the family dynamics are really important to make sure that everybody's on board. And that would also include the key employees, because likely they're going to be staying on board for a period of time. And they're part of the business family and should be at some point brought into the loop, just so that there's continuity there. And then lastly is really most business owners, after they sell, there's been studies done that, more than 50% of them are disappointed or unhappy after the sale, 2 years after the sale, because they didn't really think what they're going to do with their lifestyle. Golf, fishing, travel, that fills a lot of the gaps. But the end of the day is you've been spending 40, 50, 60, 80 hours a week in the business. Your identity has been the business. Now, what are you going to do to fill the time, and how do you identify yourself? Volunteering, things you're passionate about, but that can have an impact on cash flow as well. And it's going through all of those things and trying to plan for the potential expenses, potential inflation, and the things that can derail it are really what are going to drive, at the end of the day, is the sale the right thing and the right type of sale? But is the money that you're going to receive, is it really going to be enough to fund the lifestyle you think you're going to have?
Thanks, Jeff. I appreciate that. Great points on that. But so Heather, let's jump into, and I know you're going to touch on this in another session, but let's jump into a little bit. We've heard a lot about this value and understanding value, but what are areas that a company can start focusing on? What are these strategies that you start looking at early on? So we've got an estimate of value. We're starting to do some financial planning around that. So we're starting to work on a strategy, a thought process. What are some things that you start seeing or start working on, are areas that you can focus on to help that business increase value?
Yeah, and I'll just add, Jeff, I think you're right. A lot of times there is this huge gap between, what they really need to maintain that lifestyle. And that's where we really can focus on, okay, we've got this length of runway that we believe we're going to have to get there. What can we do, and how can we drive up the value during that time? And so at Velocity, we really look at 7 key areas. One of them is the financial health. How's cash flow? Do you have recurring revenue? Accounts payable, receivable, a million other things that, Mike, you can speak to a lot better than I can. And then we look at strategic growth. Is there a plan in place for really growing the organization? Is there a good product or service fit? Do we understand what the market, what opportunities are out there in the market? And do we have a plan to capture that? We look at customer capital. What's the relationship you have with your client base? Is there customer or client loyalty? Do you have any, raving fans, any really real advocates out there for you? And what's the diversification of your client base? Are you getting all of your income from just a couple of clients? Are you serving multiple types of clients? Should you run into issues? COVID, a perfect example of how, suddenly certain markets really just dried up, right? So you do have a really good diversification of your client base and a good relationship with them, and are you maximizing that? And then we look at infrastructure. How efficient is your organization? Process, procedure, is that defined and clear? Are people following those? What's the is your equipment up to date and functioning and well maintained and cared for? How about your IT infrastructure? Is that efficient, or is it bogging down the system? So making sure you've got infrastructure in place. And that's one of the areas, especially organizations that have kind of grown from the ground up, sometimes struggle in that it's grown very organically, and that can sometimes be messy. And then we look at leadership and people. And so, your leadership and people they really should be able to drive value across all of these other areas of the organization. They're also the easiest way to drive down the value of an organization if you don't have the right people and the right team in place. So making sure you've got a good team in place and you're able to, attract and retain that talent. And then we also look at culture. And if you think culture is a soft point and not worth addressing, ask Scott. A lot of buyers are becoming really savvy around that and recognize that culture is a really, and engaged employees is a really strong driver of value and performance. So at Velocity, we look at intentional culture. So an intentional culture aligns the values, beliefs, and behaviors of the organization to the business strategy. And so really making sure that you're being intentional about your culture and that it is in alignment with where you're trying to drive the company. And then finally, our seventh value driver, and for Velocity, we put that at the center of the model because we really feel like it's paramount to the rest, is independence from owner. So how does your organization operate if you're not at the helm for a week or a month or 2 months, right? So really working to create independence from the owner so that the leadership team and the rest of the organization can function and sustain without them. So those are the 7 key areas that we go in, assess, and then help the organizations grow across a period of time.
Well, those are all great points. I think if you look at it, that's our side of helping a company increase their value. But if you take the opposite side and you look at a buyer is looking at those same exact areas through the process. They're doing interviews, they're talking to management, they're doing their due diligence. Now they may call them something different. They may use different terminology, but those exact things they're looking for, because that's going to make it easier for them to transition a business into their platform, easier for them to take over. If everything is 100% reliant on an owner, that makes it very, very difficult on a transition. So these are increasing value because the buyers are looking for businesses that have these strong attributes. But I wanted, you said something, and Jeff, you alluded to it as well. But we're going back to this value of the business right now. I had a client who we just did this a couple months ago, where we got an estimate of value for them because he was thinking about selling the business. Now he was relatively young and thinking this is going to be my retirement plan. Well, we got the estimate of value and the dollar came back. And when you started looking at it from a financial planning standpoint, it wasn't going to sustain him through retirement by any stretch of the imagination. So now we're working on, kind of next steps. But Jeff, can you talk about that a little bit more in detail, that specific point about understanding, is this selling price really going to work for you?
Right. That's the number one discussion with regard to the business owner or anybody who's retiring. It's what's that next chapter look like for folks? Most people don't retire and then just literally sit around. They do things, and ultimately it's having that extra free time and that surge of liquidity, which ultimately can have a dramatic impact on what that future lifestyle looks like. The younger you are, literally the longer the money needs to last. Now there's some things that you can do on the front end to solve a lot of the equations and maybe take some time, but I honestly don't know many business owners or any retiree who honestly literally do nothing afterwards. They're still passionate. They still have interest. So knowing what you're interested in and passionate about is important, just to know what you're going to fill your time with. But then, as I mentioned, the spending, we know what we're spending now. I have yet to meet a business owner or retiree of any industry who, once they get that free time, they spend less. They're spending less on the business associated things and business travel, but they now have a liquidity event and they want to do those things they've never done before, they've been putting off, or take things for the family. And so some upfront spending can really be a detriment because it doesn't have time to work over time for the family's legacy. But also it's knowing your happiness, because if people are bored and people are unhappy, they wind up filling their time with other things they try, and not necessarily starting a business, but they spend more money trying to figure themselves out. There's a very large psychological aspect that goes into this. And I think as part of the team, besides consultants and tax planners and estate planners and wealth planners like myself, there needs to be some therapy or some discussion with somebody who understands the dynamics of both the family and individual dynamics that go with this identity and lifestyle change. I think that's a critical component to be best prepared. I think there's 41% of business owners out there plan on selling in the next 5 years. That was a recent national survey, but yet less than 50% of them have done any planning, and personally or for the business. And yet I know every business owner I talk to, they have a plan. They know what they're doing for their business, but they're not thinking beyond that for themselves. And I think it's understanding that lifestyle, what it's going to look like, and then taking different scenarios and stress testing them with inflation and market volatility, because the money will be invested to some extent, understanding the tax liabilities, understanding the estate planning aspects of things. And of course, the long-term goals, the legacy for the kids, for charity, for family. That can all play a very huge role on the front end, not only from the tax aspects of the sale, but also on how does that impact the long-term or the longevity of the money to make sure it does last that lifetime. The bottom line is every business owner is going to retire. They look at this, their life's work as being the funding source for that retirement. And we just want to make sure they don't pass away with $0 in the account. There is some liquidity left. And then, of course, we worry about the legacy. But that lifestyle and that maintenance particularly is, unfortunately, we can cut back on discretionary things in life. We can travel less if things are off. But healthcare, it happens. Life happens to us. And what I'm finding more and more often is people work very hard. They get ready to spend all that time. And then those healthcare things that have been building inside because we don't take care of ourselves blow up. And now healthcare costs, unfortunately, are very expensive, but they also grow at a rate much faster than inflation. And we're all living longer, but not necessarily better lives, but the costs, particularly later in life, are accelerating much faster. So it's taking care of planning for those unexpected life events that do happen. We all see it in our own families and our friends' families, that if you plan ahead for it, then you're less likely to be as negatively impacted or financially devastated if those negative events happen.
Right. Well, and so, so driving again on this point, one of the things that you mentioned earlier was after taxes. And oftentimes I hear people talk about, what can I sell my business for? What can I sell my business for? It's not that it's an unimportant number, but it's not necessarily what you're going to get out of it. And Scott, I know you part of what you guys look at too, and just trying to do some generalization, but can you talk a little bit about, the gross selling price is great, but you've got cash, you've got what we talk about is usually cash-free, debt-free. So you got debt, you got taxes and commissions and other things that are also part of this understanding and this net, what am I going to get out of the business? Can you talk a little bit more to that point about really what are you getting out of the selling price?
Yeah, no, and you're absolutely right. I mean, everybody gets excited about the purchase price, and that's what people brag about or talk about, or what that multiple was. But at the end of the day, if you sold your company for $25 million and you had $24 million in debt, after fees and everything else, you're walking away with zero, for 30 years of hard work. So it's all about, we call it, the three-legged stool, and the selling price is that total number. And that's, again, we all want to push that number up, because the higher it is, typically the more you're going to net out of that business, depending on what the debt and the tax situation look up. But really, what you're looking for is, what is that net number? That's the real money. That's the take to the bank, number. And what's the structure of the deal? Unlike a house where, you sell your house and you get 100% cash at close, and you walk away the next day, typically it's probably 70 to 80% cash at close, and then 20 to 30% in a seller note over 3 to 5 years, or an earn out, or some sellers will roll over equity. So, and then they get it, and then hopefully get a second bite at the apple 5-7 years down the road. So there's a lot of different structures, but it really comes down to that net number. And I think it was Jeff that said it before. It's interesting that 60%, so again, studies have shown nationally that 60% of business owners need to sell their business in order to live their ideal lifestyle. Because again, so many people have reinvested into it over and over again, that this is the one chance that they get to really set themselves up for success for the next 10, 20, 30, 40 years. And so what we like to say in the book and workbook that we're coming out with is, you got your total number, that's the one you're going to talk about. But, what is that net number? And then what is that lifestyle number? And it's, so sitting down with someone like Jeff and understanding, hey, here's all the assets and debts that I have. Here's the ideal lifestyle I want to live. Here's how long we think we're going to live. Is there a value gap? Again, 60% of the time there is. And then how big is that value gap? And if your net number meets or exceeds your lifestyle number, hey, great. Maybe you should take advantage of that now, because if you can live your ideal lifestyle, why wait? You can always stay on as if you, I'm not quite sure what I would do. You can always stay on as an employee or consultant for many years. And in fact, you'll probably get a higher value if you do stay on, because the buyer wants that continuity. But understanding, and then if the net number is below the lifestyle number, which in a lot of cases it is, you got two options, right? You either lower the lifestyle number, which isn't real fun, but in some cases, if you're burnt out, like a lot of sellers are, that's the option. Or B, you work with Mike and Heather and their firms and others to build up enhance the value of the company, make the company more saleable. And as Heather mentioned, the big ones are culture, management team. I've had way too many sellers over the last 2 decades, and it's like a badge of honor how many hours they put in and how great a relationship they have with the customers. And they haven't taken a vacation for 7 years. Well, they work 80 hours a week. Well, who wants to sign up for that job? So you want to make sure that you build a management team around you. Customer concentration, trajectory of the business, and that what's your margin percentage. Those are all things that Mike and Heather and their firms can help you work with to enhance that value. And then you go back and you update the estimate of value, on a regular every 6 months or every year, and you just kind of see how is it going. When does that net number finally exceed that lifestyle number, and then you can make a smart decision to go to market. But again, too many business owners just go to market because they think it's time, or they're 65 or pick an age, or they're burned out and it's not fun anymore. And I would strongly, strongly recommend for every person on this call as a business owner, spend the time and the energy and the resources to understand the true, have that estimate of value, understand the true value, understand, not only worst case tax scenarios, but there's a lot of things that you can do before a sale to set yourself up to minimize taxes, because who wants to pay more money than Uncle Sam? But once you get that first offer, there's a lot of really good tax strategies that come off the plate. So you can't go to your CPA, hey, I got this signed LOI, or here, my deal's done, how can you help me save taxes? Well, the bell's been rung, you can't unring it. And so, but the more planning up front you can do, the more you can minimize taxes, which again, just increases that net number, which ultimately helps you hit that lifestyle number sooner rather than later. And, making that decision, you get one chance to sell your business and do it right. And most owners and baby boomers only have one business and are not going to start or buy another business. So you really, the people that go into this selling their business, not knowing what they need to get out of their business and what kind of lifestyle they're going to be, can they live high in the hog down in the Keys like you talked about? Or are they going to be picking up a part-time job a year from now? You just really need to understand these things. And that way you can, instead of making these gut-wrenching, I think it makes sense now, you're making smart, well-informed decisions in knowing exactly what you need to move forward.
No, that's a good point, because, I've even got an example of, we started working with a company who was in the process of selling, and it was so highly leveraged. There was so much debt on the books that really the business owner was burned out and really just wanted to sell. Now he got a nice little sum after taxes and after the debt, but it's not enough for him to retire on. And so he's now probably he'll work another 5 to 10 years before that sum of money will be enough for him to be able to fully retire and live the lifestyle that they want to. But if we had a chance to really focus earlier on, I think that's the point for all of our attendees today, is understanding where you're at and what does that mean for you right now? What does that mean for you in the long term? And is it going to work, so you don't fall into that trap of selling too early? Because there is things through the transition planning process that can be done to work on improving that value or setting you up for success. It just may not be right now. So that was, the first section of this is really focused on understanding that discovery process, understanding where you're at. But, we keep coming back to, and actually Jeff mentioned it, Heather's mentioned it, and now Scott, you've mentioned it, this owner burnout. And which tells me that the business is highly dependent on the owner and functioning only because of the owner. So, Heather, can you kind of dig into that just a little bit more? What does it mean? Why is it such a focus for which you guys work with when you're working with companies on this issue?
Yeah, I would say hands down, of those drivers that I mentioned earlier, the one that business owners struggle the most with is independence from owner. And a lot of times it's because, a lot of, especially baby boomer generation, a lot of these are kind of homegrown businesses. They have worked from the ground up, and they've really been the crux of the organization all along. So stepping out of that role, giving up decision-making authority and things like that are not something necessarily that come natural to people and leaders. So that really does end up being a focus of a lot of our work. There's some, and that really falls on the I think somebody might need to mute.
Yeah.
Can everybody hear me okay?
Yeah, I can hear you.
Get a little bit of feedback. It stopped
Right.
now.
Should be good.
I think. Testing. Yep. Okay.
Yep, you're good. You're good.
Yeah, so that's an area that we focus a lot on. And Jeff had mentioned legacy earlier, and there's the legacy in your personal life, in your financial life, and for your family, and there's also the legacy of the business. And having a strong leadership team in place really impacts whether or not you're selling or whether or not you're trying to transition your legacy on down to the next down to, let's say, a successor or something like that, or just you want that legacy to be maintained ongoing. And it really is on the business owner to make that happen. So I think it's important whenever you're starting to build out this plan to look around and say, okay, these are the people that are going to be carrying my organization on after I have stepped out. Are these the right people? Are these people that are going to drive this organization in alignment with the values that I've set for the organization, that are focused on the mission that I've set for the organization? So making sure you've got the right people, and then it's really your responsibility to develop them. And this is a windshield exercise, not a rear view mirror exercise. So making sure you're looking for what the organization needs moving forward, as opposed to what it needs right now. You might have, at this point, you've probably grown a very successful organization, but what's led the organization up to this point might not be what we need to lead the organization for the next 5, 10, 15 years. So really getting a clear understanding of what that leadership team needs to look like, what skills they need, what knowledge they need, I think is critical. And then part of a good transition plan is really saying, okay, let's map out how we're going to transfer all of the institutional knowledge that I have over to my successor or my leadership team. What am I carrying around in my head that I need to get over to them? What skills do I need to teach them so that they can make decisions without me present, that are going to be right and in alignment with the business strategy? So those are some of the things that we look at when we're working with companies in general, is like getting that knowledge transfer in place, preparing that successor, or just preparing the leadership team in general. Because when a buyer comes in, they're not just looking at all of these other pieces, the financial pieces. They're looking at the people that are going to be carrying that organization and that culture forward. So I think those would be the key points I'd make on that one.
Well, and Heather, I think it might be fair to say that it's not uncommon when a business owner transitions the business, the buyer, they stay on for a short period of time. And oftentimes business owners struggle with even staying on because there's changes coming down from the new buyer, or they see a different way of doing things. So, that part of this is, setting the company up for success, because Scott mentioned earnouts. And so you need the company to perform well, knowing that there's probably a chance in a lot of cases you're not going to be around. Isn't that correct?
Yeah, absolutely. So really just thinking through what needs to be transitioned over. And to your point around the owner themselves kind of struggling with that, it's a shameless plug for having a good business coach to help guide through that type of transition, because it can be incredibly unsettling, and selling a business in general is an emotional affair. So really getting whoever you need in, back to that, having that advisory team in place, getting whoever you need in place early on to help support you through that, I think is really critical.
Well, and I think you're absolutely right. And, oftentimes we have managers who are very, very talented, but they don't know how to really manage people and manage strategy and those things. That's why it's critical to also, get them engaged in these processes. Jeff, you mentioned something earlier about estate planning and, wills and all of those kind of things. And oftentimes, business owners are so focused on making sure the business is operating right, they're not even considering that. Can you just touch a little bit more on why that's important? Especially, if at this point in the process, certainly, down the road, but this is a good time if you're in this discovery process, you're looking at yourself, you're looking at your business, and it seems like it's a good time. Maybe you could touch a little bit on that.
Well, I think this is the most important piece of any of it, because unfortunately, there's only two certainties in life: taxes and death. I mean, unfortunately, now with what's going on, we don't know where taxes will be, both on income or estate taxes. So again, it's a very good time to just review this in general with your tax professional and your attorney. I'm neither, but I know enough to be a little dangerous. And that's the first thing I tell clients: do you have an updated estate plan? Do you have an updated desire to look at what do you want to have happen? Because the business being that big asset, but in reality, all of the assets, all of the investments, everything else, money is only good when you're here to use it. And otherwise it's left for other people. And money is actually the only asset that I would say is different than your car and your home, even your business. Money is an emotional asset because people attest or assign so much emotion to that: hopes, dreams, fears, et cetera, anxiety. I deal with this every day with, just the gyrations. People get very nervous. And so by having a plan of what do you want to have happen is the most critical piece. And most importantly, it goes back to businesses. Typically, if you have family and you want to pass it on to family, most businesses don't make it past the second generation. You just don't have that. And so it's knowing who you want to sell it to and having options, knowing your options. But when it comes to estate planning, the most critical thing, and I call on my own experience, is not having things planned out in advance or well thought out. When my father died back in 1990, his estate plan was faulty. And most business owners, as Heather mentioned, as Scott's mentioned, there's so much of the business, the value of the business is aligned with their intellectual knowledge and their capabilities. Having not only operational plans written out for how the business should operate and training people up, it's the same thing with estate planning. If something were to happen to you, you get hit by a truck, you get disabled, something happens, how do you preserve that value and how do you make sure your wishes are cared for and executed down the road? And this is even more important in those businesses that are truly intellectual property type businesses, where it's reliant on that business owner, be it a professional practice like a law firm or an architecture firm or something where without that person, there is no real value. And if you have partners, one thing I see so often is businesses who have multiple partners, multiple owners, they don't have a thought out buy-sell agreement, let alone is it funded properly, which again, everybody knows that the business will transition at some point and there's value there, but nobody wants to be a partner with the spouse of their partner because they're not engaged in the business in most cases. So how do you buy out that spouse's interest? These are simple things that can be accomplished just with some simple up-to-date planning on the front end. But now when it comes to estate planning, it's understanding how do you want to preserve your assets for your own needs down the road, if something were to happen, but also that legacy for your kids, for your grandkids, taking into account charity. If you're philanthropic in nature, there's some strategies you can be done to potentially reduce the taxes. You may, quote unquote, get less income from the sale, but because of using a strategy using charities, you might also get more at the end because you have a charitable donation. And it's something your CPA and your estate planner can talk about. I'm versed enough to be dangerous, like I said. Mm-hmm. And then it goes into really thinking about the long term, because at the end of the day is you're likely to have something left over. What is the most important thing to you? Is it your kids? Is it your grandchildren? Do you have to protect them against themselves or other conditions? And, again, and making sure you're covered for your own needs and your spouse's needs if you're married. And it's really, I tell most of my clients, if you haven't looked at your estate plan in the last 5 to 10 years, absolutely do it. And if you don't have one, this should be the top priority more than anything. And planning is what I do. Knowing, I don't know the future of the markets, but I have history to guide it. But if we know you've taken care of all these things and we've understand what your needs might be, that will help you set the stage for how to have that successful transition, to know what you need to have. And if you're 2, 3, 4, 5, even longer years out, that's that time period to align things to give you the better chance of success versus that surprise phone call that happened to come and, hey, I want to buy your business, or health concern comes and you need to sell or get out of your business. The more planning you do on the front end, the better the outcome will always be.
That's a great point. I think, jumping in, I think really, one of the things, we talked about today was, this planning for the future, setting aside the time to look strategically, doing what I call a business checkup. Where are you at right now, right? What are those, do you have buy-sell agreements? What is your estate plan? And also, I think, Heather, you mentioned early on contingency planning. If something happens to you, you're the business owner, all of a sudden your family now has to deal with your business. And I had an exact situation like that. And unfortunately, the business was not well run and they're really struggling hard. There was no plans in place. They're having difficulty selling it, the cash flows. So it was a real difficult situation that they got thrown into in that family plan. So, Heather, just for a final comment as we're wrapping up here, could you just touch a little bit more on the contingency planning side of things? That this isn't just about planning for a sale. There's other reasons to do this.
All of those things that you just said, and again, back to that original point of, there's about a 50% chance that you're going to leave not in the way that you want. So the consequences of that, I can't remember the exact statistic about the number of companies that fail after a business sale even. So again, you've got a bunch that can't sell because they're not prepared. So then they just shut the doors and you've got employees out of work. You've got years of time and energy and blood, sweat, and tears spent building a business that lead to no financial gain for the families of these individuals. So that is tragic. And then of the companies that do sell, many of them fail because again, the organization wasn't set up to be sustainable after the fact. So really just having that plan in place, making sure that the big key areas are addressed, even if you're not maximizing the value, get it to a point where it's going to be able to function after you're gone. And a lot of times they're just not set up to do that. So yes, contingency planning is critical. And if nothing, and when you come in, if you look at exit planning, the way exit planning typically works, one of the first things they do is address the risk in the organization before you even begin trying to build value. Let's button up, the areas that you've got risk. So yeah, very important endpoint.
Very good point. I think that's a great point to end this session on. So what we're going to do, so really what you heard is here's why it's so important to begin this process of understanding where your business is at, what's your risks, what you face, all of these different dynamics that you heard, so you can make the best decisions and set yourself up for the best situation down the road. What we're going to do here is we're going to take a brief 5-minute break. We'll get back going at 11 o'clock. We're going to just switch our speakers around a little bit, and we'll get going. In part 2 will be common missteps in the business transition. So we're going to take you through, our panel will take you through a number of areas of things that we've seen go wrong and how not to fall into that problem down the road as part of a transition or selling the business process. So thank you all for attending so far. We'll be back in a few minutes.
Thank you.
Thank you.